Friends, in this video, I'm going to talk to you on a topic, what a small case investor needs to know. If you have entered the markets recently and you wanted to try your hands buying a basket of stocks or ETFs, I'm sure you would have heard of Smallcase. Founded in 2015, Smallcase has grown, got backed by very big venture capitalists, and was on the verge of getting acquired by Cred. The valuation, roughly 3,200 crores is what we are made to believe, but there are reports which vary on what the actual valuation was. But the deal was supposed to be consummated with very little cash and a lot of Cred shares. From reports that are appearing in the media, the deal has fallen through. What does this mean for the future of Smallcase? I'm sure the owners of Smallcase, the large shareholders, have deep pockets, so I don't expect them to let Smallcase down. So Smallcase will continue to be funded by them if it's not acquired by somebody. Eventually, I believe that a very large entity may be interested in buying Smallcase at more modest valuations. But as an investor, how does this affect you? I don't think that the deal per se has much of an impact on you as an investor, because I don't expect fundings to become a problem for Smallcase. So in that sense, the stability of the company may not be much of a concern. But is the platform really something which will help you invest more efficiently? That's the question that I'm going to tell you about or talk about in this video. Assume that you are an ETF investor. You're just wanting to buy a basket of ETFs. Then Smallcase is probably as good as any other platform, and there's absolutely no problem for you to invest in a basket of ETFs. But today, the bulk of the small cases are probably gravitating more towards momentum, small caps, and the more speculative kind of investments. Here, there is a significant issue, and let me talk a bit about it. Firstly, everybody going on a Monday morning and buying an illiquid stock or a basket of illiquid stocks is always going to bump their prices up. What happens after that? You see that such portfolios are doing very well. As more people notice that these portfolios are doing very well, they come in and join the same small cases. And they do the same thing on another Monday. So, scarcity drives many of these portfolios. Naturally, the volatility is higher and returns tend to be higher when stocks move one way. When the market moves one way, they will do extremely well. No doubt about it. But markets are not meant to move one way. So they are meant to move two ways. And when they move both ways, then the real pain starts, because if investors want to exit, even if a small section of these investors want to exit, the stock cannot take that liquidity. There being no control on the size of the companies which come on Smallcase or the market cap of businesses which a Smallcase portfolio goes into, a lot of momentum and volatility are a part of Smallcase, and they are structurally the core of such small cases. It's like buying an operated stock, though I would not say that anyone is operating them. The very structure ensures that stocks get operated on their own. That, in my opinion, is the biggest weakness and can affect the small investor. So, while we have raised the threshold for small investors to get into PMS, we also see the same PMS portfolio on Smallcase and a small investor getting in through the small cases. Here again, this defeats the very purpose of PMS regulations, because it is a well thought move to raise the minimum of a PMS to 50 lakhs. Now, if somebody is going to buy the same thing for 5 lakhs or 10 lakhs through Smallcase, and that investing is going to happen automatically on a Monday morning, then you can imagine the kind of volatility which it induces for that investor, and ask the question whether such volatility suits the investor. You will agree with me that the small investor can do without such volatility. But we are at a time where markets moved one way from 2020. So a lot of small investors are believing that this is the only way to invest. Here starts the real problem, because the very idea of regulation was to keep small investors away from such volatility. Smallcase does exactly the opposite. So when a PMS gets into Smallcase, it basically negates the spirit of the PMS regulation. The fee structure and the sharing formula between Smallcase and advisors is also something that deserves some intense scrutiny. It's not a open and shut thing, because a custodian charges a fraction. A stockbroking rates is a fraction. Let's assume you are on one of those platforms, Zero, the App, Stock Group. You hardly charge anything to buy, to take delivery. But just add one layer in the form of a Smallcase and your cost of ownership goes very high. Moreover, this cost of ownership does not factor in the volatility and the momentum premium that you are paying, because the impact cost for every portfolio is so high that is higher than the highest brokerage that you can imagine. This is where I have a serious problem. Whether it's a value stock or a micro cap or a small cap stock, if it's an illiquid stock, then I believe that the cost of creating a portfolio is very high. That is where the real disadvantage of Smallcase starts to hit the investor, and he doesn't even realize it, because if he buys this week, somebody else is going to buy the same portfolio later and he's seeing appreciation. So he thinks that appreciation more than makes up for all the other deficiencies. But a structural deficiency in a platform is not something that an investor can ignore. Definitely regulation cannot ignore it. It's a very, very serious issue. And I believe that it will come to hurt one day. It has nothing to do with the type of professionals, the type of owners, the intention of the platforms who back the Smallcase. It has nothing to do with them. Structurally, it will come to hurt one day, and it will hurt the small investor. Now, that is a question which we have to ask ourselves. Is that why we want technology? Is that what we want technology to do for the small investor? Is this the volatility that we want to deliver for a retail investor whom we otherwise wanted to protect from the PMS? Are we defeating the spirit of regulation by adding a layer of technology which makes the cost of ownership so much higher? Now to the most important question. Does the investor really know? Does he know this is what he is getting into? Is he told? If I go and buy a 500 rupee mutual fund, there is a disclaimer which says that mutual funds are subject to market risk, blah, 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 blah. Should there not be a disclaimer that this investing is subject to impact cost and high momentum and that you should be very careful? There is none. And that's where I think that we are letting down the small investor. And that's where we are kind of mocking the spirit of the SEBI charter and the regulation. And that's where I think we need to make a hard rethink. My thoughts may sound a little bit aggressive, but my concerns are genuine, and I hope those watching this video take these thoughts in the right spirit. Thank you very much.